Let me welcome everyone into this session, Decoding Equity Markets and Multi-Asset Allocation Strategies. Uh, if I can remember my experience of last 17, 18 years in the market, I think one person that I have always looked up to hear his views and know his thoughts and take away part of that wisdom for my own, formation of views and thoughts on markets has been Sankaran Naren, and he today joins us in this session on Twitter Spaces hosted by Kotak Cherry. Just a small introduction for Naren. Naren is the ED and Chief Investment Officer for ICICI Prudential AMC. He's been with the AMC since 2004, and he oversees the entire investment function and the international advisory business of ICICI AMC. Having spent more than 30 years in the industry, Naren has built very, very strong practices, and under his leadership, ICICI has demonstrated very strong and sustainable performance across various product categories. He currently manages many of the flagship schemes of ICICI Prudential Mutual Fund. And of course, Naren brings in vast experience ranging not only around investment management, but he's also had past experience ranging from investment banking, equity research, and stock broking. So, Naren, thank you so much for taking time out, and I hope that our listeners will really find this session worth its weight in gold. And we're going to discuss that as well a little, but I really think that it will be a very interesting session. Thank you for joining in.
My pleasure. My pleasure.
Okay.
I hope I'm audible and clear.
Yes, absolutely. You are audible and you are clear. Let me dive into the topic straight up. We would want to know from you, Naren, what exactly diversification mean for you, given the juncture at which we are in market, and in general, from investor standpoint, what exactly is diversification and why is it important? And just to give you a little background, we have got host of listeners with different kinds of experience, so you can talk about it for the most uninitiated listeners as well. So very happy to hear your views on diversification.
See, I started investing in 89, and actually investing was, I thought that there was only one asset class required called equity. And all the way from 89 to 94, 95, despite Arshad Mehta correction, I felt that, equity was enough for everyone. And but when later 97, 98, when the Asian financial crisis hit, and there were some problems arising out of MS Shoes controversy, and my entire process was that there is only one asset class required called equity. And what happened to me in 97, 98, it was very depressing to me, and I realized that having only equities as an asset class actually was a very wrong thing to do. And in those days, I was actually a stockbroker in 94 to 98. Not only did I watch what happened to me, but I also could watch what happened to a lot of my customers at that point of time. So after that, I used to tell people you can't depend 100% on equity. And while I remained a stockbroker from 98 to 2004, I used to tell this to people in 99, 2000, and people didn't listen to me in 99, 2000. And this was based on my own 94 to 98. And frankly, people again got badly hurt in 2000 to 2002 with equity only strategy. And again, I mean, like after that, I realized that I should not remain a stockbroker because somehow a stockbroker was always dependent only on equity. So I moved out to fund management actually. And
Okay.
again, I realized by being only an equity fund manager, I again suffered in 2007 8. So I decided to become a CIO of equity and debt. So this is the long story. I thought I've given you a long answer, but that is why I moved to a situation where I became CIO of equity and debt and actually marketed categories like balanced advantage fund, equity and debt fund, multi-asset fund kind of categories because then I found that even when COVID hit, it did not hurt us.
While you said it's a long answer, but I don't think so. There can be a better pointed answer. This is your own experience to tell people why diversification is important. So that's interesting. But Naren, tell me that how exactly this kind of diversification can work, especially in current market times when we all keep hearing that markets are expensive, but people keep finding, or rather, I would say, people are not able to actually think of reasons why markets could correct. So, if you could just link that to the current context of markets and how could this be relevant?
So,
Yeah,
so the challenge is that everyone believes that they can correctly predict when any problem will come, what will happen. None of us could have predicted what is happening in Hamas, what happens. No one can predict. So the only way diversification is the only way in which you can ensure that you have taken care of yourself. Did anyone predict in 2007 what problems would happen in 2008? The answer is no. Did anyone predict COVID? The answer is no. No one predicted many of these things. So it is only in retrospect people know what had happened. So that is why diversification is the only solution.
okay. So, Naren, I would also want to know when people start thinking about diversification, what should they be considering? Should they be thinking of asset classes first? Should they be thinking of what mix of asset classes and how mutual funds can play that role of helping investors play that role well? If you could throw some light on that as well.
See, the important asset classes are equity, debt, gold, for example. Obviously, real estate is outside the domain. We have REIT InvIT in the mutual fund space. So anything which involves equity, debt, REIT InvIT, and gold is diversification, which is why we moved to a situation where bulk of the time we believe from a category point of view, we have started to like multi-asset because that is the only way in which you get all the asset classes and at least some of these asset classes are uncorrelated. So if you look at REIT, for example, they have done badly over the last 1 year, and gold is something which has done badly over the last 10 years and even over the last 3 years. So we like at least asset classes which have done badly. So if you look, many of the REITs have done pretty badly. So that is what we recommend as diversification, and all that you can do is multi-asset in an Indian context. Maybe globally, many more things are possible, but we have to look at what is possible in an Indian context.
So you are saying a combination of equity, debt, gold, and of course in a very minor manner or small manner, REITs and WITs. Those are the
Yes,
four
yes,
categories.
yes.
Now,
And actually, what is possible in multi-asset is also exchange traded commodity derivatives. So that involves that you can have small positions in silver, small positions in oil, small positions in some metals. But given the depth of the market in India, those positions have to be very, very small. They can't be large.
okay, okay. And in all of this, typically we keep hearing the fact that asset classes move in cycles. So when equity markets are doing well, fixed income markets may not do well. When fixed income starts to do well, maybe something else will not do well. So I'm just trying to think from a investor's point of view, uh, how can one effectively play across these asset classes? Is it easy to just look at an asset class and say this asset class did not do well last 2 3 years, so now maybe I can have exposure to that asset class, or is there more to it? And in that manner, how you at ICICI AMC look at running such kind of multi-asset strategy and allocations?
SEBI has created a multi-asset category itself, which allows you to invest in one fund, all these things. So all of us have this category in our portfolio. Many of the mutual funds have this category in our portfolio. And in one fund, you have all these things actually. And that is how we look at it at this point of time. So we have some limited flexibility in this fund, in this category, to increase and decrease weightage to the asset class based on what we like and what we dislike. It is not the flexibility is, I would say, limited, not exceptional, but then still that limited flexibility does exist.
And within that flexibility, how, broadly speaking, how are allocations made? Is it more just the cyclicality of asset classes? And I'm wanting to ask this more so that our users understand how this really works and benefits in their favor. That what exactly is the thought process behind deciding whether today equity allocation needs to go up or tomorrow some other asset class allocation needs to go down? How exactly is that uh,
So
done at a
basic,
broader level?
So basically, what we have is that we have a multiple number of fund managers in our company. There is a person in our company who looks at debt. There is a person in our company who looks at arbitrage. There's a person in our company who looks at gold. There's a person in our company who also doubles up and looks at exchange traded commodity derivatives. There's a person who looks at REIT and InvIT. Then there's a person who looks at equity. And I'm also involved in this fund because I have more experience in looking at many of these asset classes. So we do all these things by allocating different amounts to different asset classes, and that's what we do actually. And there will be a time when we will allocate whatever is the maximum to equity, and there will be a time we'll allocate a slightly lower level to equity. And within equity also, there will be a time when we'll allocate a lot of amount to large caps, and there'll be a time we'll allocate a smaller amount to large cap, depending on where we see. So and even within large cap, there'll be a time we'll allocate a lot of amount to banking, and there'll be a time we'll allocate a larger amount to some sectors like, let's say, power and telecom or oil and gas or something like that. So we have a fair amount of flexibility in this fund, and we'll continue to make use of that flexibility. But as you know, fund managers can also make mistakes. We are all human, and that is how it is.
No, that's a fair point, and of course, I think only fair to assume that with a combination of all of those fund managers and experts, at least from a investor standpoint, one can assume that they will do a better decision making than what an individual investor may do with lesser information. But as you said, markets can be a great leveler. Sometimes people can get lucky with their allocation, but that may not sustain for long periods of time. That's why maybe such kind of expert-led funds may work better. Maybe digressing a little bit, but uh, does it normally happen that the allocation that is getting followed in your fund strategies is the allocation that you follow in your personal portfolios?
See, each the way I look at it here, there are clear scheme level rules which have to be followed as per the SEBI document. Personally, one is at a particular stage in life, and one has a certain ability to take risk and a certain ability not to take risk. So I think we operate in a particular way. I would say in 90s when I was very young, I had the ability to take a certain very high level of risk, I would say. If I go back and think as to how high a level of risk I was taking in 1990s when I was in my 20s, I don't think I am willing to take that level of risk in my 50s now. So things change. And so that is why, any financial planner also cannot have a single fit model to look at how every individual manages. And whereas fund is run based on what SEBI says, prescribes, is the scheme information document. So we follow the document and run it in that manner. So, and that document has certain flexibility available to it, and we will use the flexibility that the document allows us to do. And based on that, it is possible. Finally, we are responsible for public investors. We have to remember that. And we have investors of all types. So we have to keep that in mind all the time. So our goal is not to try to hit sixes every day. That is not the goal of ICICI mutual fund, to try to hit sixes every day and get out. Our goal is to try to be more careful, because finally at the end of the day, what we have realized is that across all our products, we don't try to hit sixes.
Interesting. Given the context of we are in between a World Cup, and hitting sixes is not necessarily the only thing which is going to win matches. So I guess that should be important for listeners. Naren, tell me one more thing. We have also seen, and this is more a fundamental question. I'm seeing, I'm asking, listening to what you just said. Individually, you are saying for each person, one needs to know what is the right asset allocation mix, and what kind of risk one is willing to take should decide how one should go about it. So in that manner, I'm just trying to take example of two extremes. Let's assume someone who's in their 20s or 30s, earning starting to earn a stable income, has high risk taking ability. How does a multi asset allocation strategy fit for him? And similarly, if I take it to the slightly other side of, let's assume, a 50-year-old or a 60-year-old, maybe more planning closer to retirement with income streams coming closer to their end, and then they need to plan for their future. For both of those scenarios, uh, how does one think about multi-asset strategies? And in a manner, if you can also maybe stretch and add any other uh, thoughts that you have beyond multi-asset allocation strategies, also it will be helpful.
Yeah, you see, basically what I have learned in my investing career is that the past affects your thought process. So if today you have had a 10-year period where mid cap and small cap has delivered 20% per annum, the and large cap has delivered a much lower return. People ask, why should I not invest in small cap and mid cap? And today, people say, SIP sahi hai. You should have invested in SIP in China fund for the last 10 years. You would have known what SIP could have delivered over 10 years. It would have delivered a disastrous experience if you had done SIP in China fund for the last 10 years. So what happens is, go back to a period like 2006 to 2013. 2006 May to 2013 August, that 6 years and 3 months, mid cap did extremely badly, mid cap and small cap. So in that 6 year and 3 month period, if you had run mid cap fund at that point of time as a SIP, your experience would have been disastrous. So today people come and tell me, I want to do 20-year SIP in small cap. I tell people, if you had run a small cap SIP from 2006 May to 2013 August, and you continued that SIP from 2013 August to 2023 August, by all means continue, do a 20-year SIP. But if you have not done a SIP between 2006 May and 2013 August, then and you come and tell me today I will do a 20-year SIP in small cap, I'm not sure whether you'll actually do a 20-year SIP, because when you have a period of time when small cap does badly, you will start distrusting small cap. Just like today, everyone will distrust China at this point of time. So what I believe is that there is so much of anchoring based on the past which happens at a point of time. So I always worry, when people do derivative trades in a very big way, I ask them, do you know what are the risks of derivative trades? So somewhere anchoring is something which is very, very important. Anchoring means how high have the past returns been? So if returns have been very bad in the past, I'm extremely happy to recommend that product and say do SIP, do STP, do whatever you want. But if returns have been very high in the past, like last 10 years of small cap, then I tell people think, because last 10 years is not equal to next 10 years. And everyone wants to equate the last 10 years with the next 10 years. So I remember when I became a fund manager in 2004, one of the main reasons I became a fund manager in 2004 was the reason that from 1994 to 2004, forget SIPs, most people lost interest in equity market and ran away from equity market. I was one of the few people who stayed in equity market. So I got a job as a fund manager for staying in equity market, I would say. Forget doing a SIP.
Okay.
So, so I believe, people are too anchored by the past. So I will tell people take risk after bad returns and take lower risk after high past returns. Take lower risk after high past returns. And I find it so difficult to convince people that risk is lower at bottom and risk is much higher at the top. So in 2020 March, risk was very low. In 2008, after Lemon, risk was very low. Whereas risk is now much higher in small and mid cap than it ever was. But to convince that to people is absolutely impossible at this point of time. And that is the challenge of, I believe, investing. So 3 years back, we used to tell people PSU is low risk. And people used to say, no, 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 PSU is high risk, metal is high risk, quality is low risk. But see what happened, 3 years gave huge return in PSU, but because it was low risk 3 years back. So that is a challenge of investing, and how to get people to understand that lower price means lower risk, high price means higher risk is one of the biggest challenges that I've seen in my investing career of 19 years in fund management, 10 years as a stockbroker, and 4 years in investment banking.
So what I'm hearing you say is common sense is not so common, and investors need to be really, really careful about their investment choices. So, uh, Naren, that actually brings me to the point that uh, many of our investors ask that question that we have seen now practically two wars break out. We have practically seen oil prices go back closer to uncomfortable levels. Interest rates are at all-time highs. Market is absolutely standing tall against all of those pressures, which typically one may assume should be able to break the velocity. So, while you said that it's impossible to predict what can lead to failure, I will ask the other question that after all of these situations, what is it that is keeping the sentiment so high, having your experience of seeing similar kind of cycles in the past?
The sentiment is high because of EPFO investing consistently, National Pension Scheme investing consistently. The very good work done by people like Kotak Cherry and all the mutual funds, including ICICI, in popularizing SIP. The lower taxation on equity compared to debt. I think all these things have played a big role in this. And slowly, over a period of time in the last 10 years, everything in equity has become more expensive. And that is the reason. And also, very good macroeconomic management by India over the last 10 years has resulted in a situation that the current account deficit or inflation in India has always been very carefully managed, unlike what has happened in the rest of the world. So I think these are the reasons. Does it mean this anything extends forever? I'm not a believer in that because I have a guru called Howard Marks who believes in cycles, and it is because that we believe in cycles that we believe in multi-asset. But the fact is that India has been managed well from a macroeconomic standpoint. It has been managed well, but the valuations are not cheap. And that is a reality.
So let me spend 2 minutes in asking you more about equities first, and I'm then wanting to have your views on fixed income and gold and other asset classes. But uh, first on equities, since you said that year and a half back or 2 years back, you were talking about certain sectors which look cheaper. In current context, which kind of sectors or what pockets of market in terms of market cap, etc., look better placed or value for money for you?
Yeah, actually, it is only better placed. Nothing is real value for money. Clearly, large cap is cheaper than mid cap and small cap. Clearly, sectors like financials or power or telecom or energy is better than other sectors. But nothing is mouth-watering. Nothing. That is a reality because you have to remember you've seen 10 years of fantastic returns. So nothing is mouth-watering. Is there fear in the market? The answer is no. To make money to make big money, you need fear. And there is no fear. Go back to 2020, you had fear. Today, where is the fear? So frankly, you need fear to make money and to make big money rather. So that is the reality at this point of time that we don't have fear. And you can make out that there is no fear in India. Everyone knows India is a structural story. No one is doubting that structural story. But to make mega money in markets, all my gurus say you need fear, and you need actually fear and valuations being low to make mega money. You don't have that at this point of time. So that is the reason why we are in this multi-asset phase. If we had fear, we would talk a different story altogether.
I'm sure we would be talking first up on gold at that point of time. But I'll come to you on those, Naren. But just before I go there, while what you said makes a lot of sense, apart from what we hear from domestic fund managers or investors, how is the global investor looking at it? Because we have also seen not only Indians buying Indian stocks, but a lot of foreign investors and FIIs coming in buying India in a reasonably large amounts over the last years, and of course uh, that's helped the market as well. So how is that sentiment? Because you, I'm sure, are also talking to foreign investors investing through you. So also keen to know their thoughts on India.
Actually, no, they are talking positive and but not buying big. Because what has happened to them is they were used to zero interest rates for too long. And today, 2-year US debt is available at 5%. So actually, they are only talking positive. They are not investing big money in India. Frankly, if they were also investing big money in India today, I would be much more negative. Frankly, they are not investing. Every day, they are actually disinvesting. If they were also investing aggressively, domestics are also investing aggressively, then we would be much more negative. But foreigners are not investing aggressively. There was a period, April to August maybe, when they
Correct,
were
correct. Yeah, I
investing.
was referring more for the financial year. Yes. Yeah.
Yeah. But right now, they are again disinvesting. And frankly, why they are disinvesting is because interest rates are so high right now there. So they are moving money to debt. They're saying, today it seems you can get good quality debt at 7-8%. They're saying, why should I take the risk of investing in an emerging market when I can get 8% in debt? And they're all countries where normally debt gives them 2-3%. So do I expect 2 years from now FIS be investing much more than what they are investing today? I seem to think so. And that is one of the reasons why I am not so negative actually. If I had believed that they are also investing aggressively today, then I would be negative. But I feel 2 years from now they'll be investing more in
Okay.
equity.
Okay. You spoke about high interest rates there. How are you looking at that situation more for Indian investors? As you rightly said, people are looking at almost all-time high interest rates in the last 10 odd years, and now there are fixed income options offering 8%, 9%, 10% kind of returns. How do you envisage that? It's going to stay higher for longer, or there is a chance that that also may start to turn down?
I think the moment you have one good big equity correction in US, no, it will turn down. So I think it's the funny thing is I believe that a big equity correction, let's say 10-20% of equity correction will lead to interest rates coming down. So that's why if you're a long-term investor, you don't need to worry about it. If you're a short-term investor, you have to worry about many things. So as a long-term investor, you don't need to worry about it.
You're talking about fixed income, interest rates, right?
No, even equity, fixed income, I don't think there's any big opportunity in global markets which you can use as an Indian investor at this point of time. But I'm saying that what we expect is there will be one big slowdown in US and then interest rates will come down. Now, people are trying to time that. I don't have a knowledge to time that because people expected that that slowdown will be this year. It did not happen this year.
Yeah. And from Indian interest rate standpoint, having seen inflation remain above the comfortable range that RBI normally feels okay, isn't there risk there for interest rates to also remain higher for longer?
It is. I think we are in this range bound interest rates in India. Nothing much to do.
Okay. Okay. Uh, Naren, within the asset classes, I think one other thing that I'm sure people want to know is your view on gold, having seen geopolitical issues, and gold has started to go up in the last month or so since the whole Israel issue cropped up. Any specific views on gold, or how should investors think about it?
We think gold is a good asset class, and we think that gold has good long-term future from here. And one can invest in gold through multi-asset strategies or choose gold ETF or sovereign gold. But I believe that every investor has to have a decent exposure to gold through multi-asset or sovereign gold or gold ETF at this point of time. It meets one of my requirements that past returns should be bad. So right now, if you look at it, past returns are reasonably bad. 10-year returns are bad, 3-year returns are bad. So it meets one of my requirements for good long-term investment. So I believe clearly one can consider gold.
Interesting. Interesting. Uh, Naren, maybe I will also want to know from your side what are the risks that you are looking out for? What are the alarm bells that you are looking at which may trigger a change in view?
I think the biggest risk at this point of time from the domestic investor point of view is that many of the new investors in the market don't know what is equity correction, don't know negative returns in equity, they don't know the risk of equity market. And the number of investors who have come into the market after 2011 has been too high. So they all carry some perceptions of equity market. So that perception is that equity market, if it comes down, will be like March 2020. It will come down for 1 month and recover the next month. So those perceptions are all wrong. So it has nothing. Equity market carries its own risk, and the smaller the capitalization, the risk is higher. Uh, so these risks are not understood by investors in India at this point of time because risks have not played out after 2011. And too many investors exist in India who have invested in the market only after 2012. So I worry about that. I'm not worried about the India structural story or any of those things. I'm more worried about the wrong perceptions of equity market in the minds of investors who have entered the market after 2012. And that is the biggest worry I have. And I don't know whether how many people trade the derivative market without understanding. I have no idea about that. So that is the second risk which I am worried about, because I don't know whether they understand what they are trying to do in the derivative market. This is the second risk. And all these are nothing to do with uh, the fact that India is a great investment destination over a long period of time. But that doesn't mean that the Indian market is cheap or returns are going to be like what it was in small cap over the last 10 years. So that is not guaranteed return, and that is the challenge, if you ask me. I think what is good, if you ask me, is that there are phenomenal market structures in India which have been created, which include the entire regulatory system, the NSE, ESC, mutual fund, entities like Kotak, etc. So, but they also allow you to redeem fast. Whereas in real estate, when people got caught in 2014-15, they just didn't get an exit. So due to that, they managed to save their skin and they didn't lose money. Whereas in this entire financial system, we have created such a fantastic system that people will exit because they can exit. Whereas in real estate, we never gave an opportunity to exit. And therefore, people didn't lose money. So I'm very worried that people will get an opportunity to exist because of the efficiency of the regulatory system. And that is my worry.
And mutual fund industry per se has, of course, also seen multiple new AMCs come in, Naren. So, uh, any thoughts or views on
It is not a
this?
problem. We have to welcome competition, and regulatory infrastructure is very good. Each product is managed as per the scheme information document. But if you invest in a small cap fund, you will get small cap SID. If you invest in a multi asset fund, you get multi asset SID. So, frankly, you will get what the product is meant to do. We are not asset allocators, we are product managers. So, if you give us money in multi asset or balanced advantage fund, we will do what it takes. If you give us money in mid cap fund or small cap fund, we'll do what it takes. So, you have to, that is in your hand, but there's nothing wrong with either the regulatory system or with any of my new entities which have come into existence.
Actually, that's a important point, that while there is a lot of excitement and a lot of new AMCs, and of course there are a lot of existing AMCs like ICICI who have been managing money for decades together. But as you rightly said, it's a very well regulated industry. So in that manner, from an investor standpoint, it's the most investor friendly thing which can happen. But individual investors have to keep their own caution at in their own hands and decide what kind of risk they are comfortable with, and be cautious of the current situation of the market. So I think that's a takeaway, Naren, and I'm clearly hearing your risk uh, thoughts that this is not the market which gives you the most comfortable expectation of return on equities, and there are other asset classes that are equally important. And I think that's uh, that's a fair summary to take away from this conversation. With that, maybe Naren, I'll thank you for taking time out and sharing your valuable inputs. It, I think, is a timely discussion to caution investors about how they go about making their allocations, and in some manner, if uh, they are wanting help, then I think multi-asset allocation funds can do that job very well, where experts like you can take that control and ensure that the ride is much more smoother with less surprises. So I think that's the takeaway I'm taking from this. So thank you so much, and we look forward to many more conversations with you in the future.
Thank you.
Thanks,
Thank
thanks, and thank you everyone for joining in. We look forward to seeing you next week.